Jerome Powell just surprised the markets with a 50 basis point cut and signaled to the world what we've already been feeling. We're in a recession. Despite the S&P hitting all-time highs and GDP being touted as strong, the labor market is grinding to a halt and unemployment is about to skyrocket. If you are paying attention to what Jerome Powell revealed during the Fed meeting, you know that the cracks are starting to show. I'll reveal what the Fed is not saying out loud, but they've published in their Beige book. And despite all of these things of a real-world recession, liquidity is coming into the financial markets. And that means that Bitcoin is about to take off. And not to mention, the world's greatest market maker, Larry Fink, just doubled down on Bitcoin as an uncorrelated asset. Are you positioned to capture this massive explosion before it happens? Let's get into it. I'm Dante Cook with Bitcoin Simply, helping you make sense of the macro environment and markets in a way that's easy to understand. If you haven't already done so, subscribe to this channel. You'll get fire insights and originals like this twice a week. And with that, let's get into today's episode. Last night, Shohei Ohtani proved why he's one of the greatest to ever pick up a baseball bat. He went 6 for 6 with 3 home runs and 10 RBIs, and becoming the first person to be a 50-50 baseball player. 50 home runs and 50 stolen bases. Speaking of 50, Jerome Powell cut rates by 50 basis points, also joining Shohei Ohtani and cutting for the first time since March of 2020, when the Fed had an emergency rate cut and cut rates to 0%. The S&P responded accordingly, hitting all-time highs. And Bitcoin rallied as well, going from 59K and touching 64K earlier this morning. I love that Jerome Powell is a master of telling you everything that you need to know without telling you everything there is to know and nothing all at the same time. I do appreciate that he's getting rid of this forward guidance crap, and he's letting the markets decide and find out things as he's making decisions in real time. He reiterated several times in the Fed meeting that they will adjust when data from the market adjusts.
A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks.
But here was one of my big takeaways, is that clearly the Fed is shifting away from taming inflation to getting back to their dual mandate of price stability and employment. And you know why I think that they had a 50 basis point cut? Employment and the labor markets and the economy aren't as strong as they're letting on. This snippet right here took me down the rabbit hole to discover for myself, was the labor market actually as strong as they're admitting? And is the economy as strong as they're touting?
We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige book.
Instead of just taking his word that the labor market and growth in the economy is strong, let's actually dig down to find out for ourselves. According to the Challenger survey, which is the most prominent survey on employment and hiring in the US, it has been a bloodbath. Hiring is grinded to a halt. It's actually at its lowest level ever since they started tracking this data in 2005. And on top of hiring grinding to a halt, layoffs in August hit over 75,000, 193% increase since July, its highest number since 2009. Companies like IBM are laying off thousands of jobs. And it's not just IBM. There's dozens of other examples of US-based companies laying off thousands of employees going on strike, reduced hours, or people willfully leaving the workforce. Even though they're not a US-based company, Volkswagen said that they're laying off 30,000 employees. And I believe that this is just getting started. The Fed themselves actually said that the market is starting to crack. In their Beige book, which is a publication that highlights all of the data that they're collecting from their 12 regional Fed board governors, is saying that the economy is slowing down. The overall economic activity in 3 markets was up slightly. They don't define slightly, but it was flat or down in the 9 other markets that they're in. The labor market is considerably cooling off. They say that employers are facing uncertain economic environments. They say that employers are shifting to a strategy of reducing hours and shifts. Doesn't sound like a strong economy to me. Consumer spending was down in every district, and they're saying that consumers are getting more conscious and downgrading to cheaper or more cost-effective goods, and that restaurants and retail are down in all segments. Prices, they said, were up modestly across every segment. They say that manufacturing is slowing down in most districts and that demand and also backlogs are shrinking. They say that real estate and construction is down, primarily in single family and multifamily developments, but also in other developments as well. They say that loan volumes are flat or down despite there being high credit quality. And here's the potential red herring. They said that community services such as housing, medical, and other forms of subsidies are being used at a high rate. And nonprofits that serve these sorts of needs are having trouble getting funding. Well, that's because the people have less discretionary income. These aren't my words. These are the words from the Fed themselves. And you know what also is interesting? In their own projections, in June, the unemployment rate would be at a peak of 4% through all of 2024. We're already at 4.2%. And they're saying that the peak for unemployment is going to hit at max 4.4% through 2025. And this is not even possible because Claudia Sam, a former Fed economist who took an indicator from Ed McKelvey, already broke the indicator that the recession is in effect. The SOM rule says that the average of the last 3 months of unemployment, when subtracted from the difference of the lowest amount in 12 months, if it goes greater than 50 basis points, then we are in a recession. And how accurate is this reading or this measure? 100%. And typically, when the SOMS rule breaks or the indicator gets triggered, then the unemployment rises sharply, beyond 5% and even over 6% in some instances. Danielle DiMartino Booth talks about this on Jack Farley's podcast.
In a repeat, if you will, of what happened in the aftermath of the financial crisis. When I was inside the Fed, they moved the goalpost to saying now we expect the unemployment rate to be 4.4% at the end of 2024 and the end of 2025, for there to be some kind of immaculate soft landing that the Fed can somehow engineer that only moves the needle on an unemployment rate that was rounded down to 4.2%. They think it's only going to increase by 0.2 of a percentage point between now and the end of 2025. And they know that once the McKelvey rule or the SOM rule, whatever the rules are that are triggered, which was not untriggered, by the way, by the tiny little 4.3 to 4.2 adjustment in the month of August. The SOM rule was not untriggered. They know that history dictates that now you start to see the unemployment rate rise in earnest. He did reference initial jobless claims, but very good work that's come out of the Fed recently has shown that the unemployment rate itself is understated because of the gig economy. Hey, I live in the state of Tennessee. State of Tennessee is only going to pay me 12 weeks of unemployment insurance. And by the way, probably won't even amount to $300 a week. I've lost my full-time job. More than 1 million Americans on net have lost their full-time jobs in the last 12 months. What are you going to do if the state of Tennessee is going to give you that little money? You're going to start driving Uber or Lyft or DoorDash. And that's exactly what we're seeing. It's why we're not seeing increases in the initial jobless claims, but we're seeing a persistently high level of continuing jobless claims. And it's because these people are feeding into the part-time employment pool, and we're seeing part-time employment go absolutely through the roof. It is actually, Jack, at the highest level that it was already during the great financial crisis, part-time employment.
So all of this says to me that we're in a recession. And I'm not going to use a chart to provide some sort of crutch or comfort for me. It's just common sense. Hiring slowing down, layoffs are picking up, and we know that payroll's number has been overinflated by almost 1 million jobs in 2024. And this doesn't even go to mention or bring in the fact that these are non-US immigration-related job and payroll growth numbers. And the majority of the hiring is not in the private sector. It's coming from the government itself. So is the actual economy strong? But here's the other reality that Nick Bhatia points out extremely well.
We have a very simple way to approach financial markets that what we're basically doing is trying to judge where the economy is. And we've discovered here over the last few years that that is too basic of a way to approach financial markets. And there's this concept that we're working with more now, which is liquidity. It's the size of the banking system and the ability of the financial system to create credit and to create money. And that money creation and credit creation is what fuels markets, not necessarily just the economy by itself. So that is the premise that I want you guys to take, not only today, but throughout the rest of your macroeconomic study, that it's not just a one-to-one relationship with the economy and stocks. There is this huge supply of debt around the world, over 300 trillion of debt. And that debt has to be rolled. The ability to roll that debt, it comes from two places. Of course, the borrower's ability to prove that he, she, or the company can pay it back, but also the bank's willingness to extend that loan again. And the bank's willingness to extend the loan is the primary dynamic that makes all of these markets tick.
And this is a sad reality, is that there is a difference between Main Street and Wall Street. Although we could be having a recession in the real world, it's actually the fake world or the financial world that we live in, where they're able to create credit or create money out of thin air that dictates whether stocks or risk on assets like Bitcoin will go up. I hate the fact that we live in a world that our financial economy is just made up. But like Scott Fitzgerald says, you need the ability to hold two opposing ideas together at the same time and still be able to function. There can be a recession or a collapse in the real world, which creates disparity between the haves and have-nots, and more prosperity in the people that own assets. Although I don't like that there's disparity, I do want to take advantage of the greatest asset opportunity that we will have in our lifetimes, and that's Bitcoin. Liquidity is going to flow into markets, and more liquidity is going to start to flow into Bitcoin versus other alternative assets. You can take this to the bank, especially when the largest asset manager and the greatest market maker in the history of finance, in Larry Fink, is beginning to say that Bitcoin is a scarce, decentralized, non-sovereign, and uncorrelated and unique diversifier to add to your portfolio. In their latest report, BlackRock says that Bitcoin will gain on the global monetary instability, the U.S. fiscal unsustainability, and U.S. political instability. All of these things, combined with our rising debt levels, create a unique opportunity for assets that would have plowed into things like gold to flow into the 21st century gold, Bitcoin. In their report, they highlight that Bitcoin and gold are non-correlated to the S&P 500. So they're zigging while the S&P is zagging. Also, when things hit the fan and we are in an economic or another type of crisis, Bitcoin actually outperforms the S&P 500 and gold significantly. And so as debt continues to grow, the markets are clearly pricing in through gold and through Bitcoin that these are the safe haven assets moving forward. So here's my takeaway. I'm cautiously optimistic. I truly believe that we're in a recession, despite what they may say about GDP and growth, because GDP isn't actually the thing you should even be looking at. GDI, or gross domestic income, and the disparity between the two is a real indicator of whether or not we're in a recession. And right now, the gap between GDP and GDI is $616 billion, the highest level we've seen since 2008. Because inevitably, the financial world or the fake world has to come to grips and come in alignment with reality. The growth on paper has to somehow hit people's pockets in a real way. But you also have to be bullish. Based upon history, anytime that Bitcoin finishes with an up month in September, there is an extremely explosive move to the upside the last 3 months of the year, starting in October or October. Some analysts, like Joe Consorti, are calling for 100K Bitcoin by Q1 of 2025.
If we get this kind of proverbial soft landing, maybe we get a little bit more inflation, and the Fed can bring rates down to neutral without igniting a whole lot of price inflation, Bitcoin stands to do even better in the near term. So I don't usually throw out price targets, but I do think Q1 2025, probably right around the time that Bitcoin, blasts through 100K.
But with all things, I don't want to just leave it to what the analysts or what people like me say. What do you think? And if you want to begin navigating these topics like this in real community with real people, join Columbus at joincolumbus.com. And with that, we're signing off for the weekend. I hope you guys enjoyed the deep dive on the recession that I believe that we're in, but also not being so paralyzed by a recession that you don't capitalize on the liquidity coming into the market and the boost that we probably will see in Bitcoin's price. Be sure to subscribe, set your notifications, and get fire content like this delivered to you on a regular basis. This is Dante Cook with Bitcoin Simply. Happy stacking.